talking about number one, capex for this particular facility. Number two, you also have quite a large biosimilar pipeline. Could you give us a sense of the kind of pipeline that you have, the kind of capex that you envisage, and on the back, especially H2 onwards, you're going to see the Pen-G also start kicking in. On the back of that, how do you see number one, capex trends, and number two, how do you see debt pan out, especially at the end of FY25?
In terms of the in the biosimilars to biologics, this is the only capex which are going to put, which can be around one third of the total outlay, which has been told you earlier. In terms of the biosimilars, I don't think any more capex, and Satakarni has already got the plant in place, and whatever we are incurring on the R&D is being charged to the P&L. So there is no more capex on the biosimilar other than the sustenance capital or the maintenance capital, which he is working on that. In terms of the, what's your second question?
The debt outlay.
The debt outlay, if you really see as on date, we are having around net cash of around 20 million by end of March. And the Pen-G project, we have more or less incurred the major capex. We have already incurred around more than 200 crores of capex already. Probably another 300 crores may be left out, which will be incurred during the year. And the Pen-G the commercial batches have started one by one. So probably we'll operate all the commercial batches simultaneously sometime in September, October. So I don't think any more capex is required for Penicillin G at this point of time because we are going to start full log in the month of September. Probably if we need any capex, probably it may come in the next year. So overall, the capex which I said at the beginning of the year, could be on the existing businesses. We'll be incurring around 200 million capex, and plus if we buy any market authorizations or ANDAs, etc., which is over and above that. But for the existing plant, etc., maximum we may be needing around $200 million. That's what we think.
All right. Well, I just wanted a larger industry question when it comes to biosimilars. Mr. Santhanam, if you could take this one. Do you see a lot more such CMO opportunities coming about when it comes to biologics simply because of the US Biosecure Act?
I think as Satakarni said, this is the first biologist contract which he is working on, and there is a lot of potential. And I'm sure he is working on multiple things, maybe at a later point of time. I think this is the contract which has been entered on Friday. So probably you may need some time to do more work, and then probably we may be able to tell at a later point of time.
Okay. The other question that I had is that contract manufacturing for biosimilars, does it make more sense, Mr. Santhanam, than launching your own portfolio of biosimilars in competitive markets such as Europe as well as the US?
I think our biosimilar team is strongly feel they can do it, and I think that is the only vehicle we are having. Curatech and is the vehicle which can do the entire thing, and whatever is being contemplated, Satakarni is already doing that. And we don't think for the existing products, I think we are working on 7-8 products, and we are already full, and probably you may think about it to get into other CMO activities maybe at a later point of time, probably next year.
Couple of quick questions. FY25, how do you see price erosion as far as the entire generic space is concerned? Analysts in fact believe that Aurobindo Pharma has the most sensitivity, and in fact they believe that if price erosion is contained as far as FY25 is concerned, there could be significant EBITDA guidance upgrades that could come in. Give us a sense of what is it that you're seeing on ground.
In terms of the generic price erosion, which we have been informing the market, even in the earnings call, we talked about it at length. We don't see a price erosion at this point of time. We are seeing a price stability. And what we are trying to do is we are trying to increase the volumes significantly. And we don't see any price erosion happening for the next 2-3 quarters at least.
Okay, so you're quite sanguine in terms of the price erosion or stability in terms of the US prices. Give us a sense in terms of the guidance for FY25 then. You did mention that it's probably not going to be, it's going to be growth in double digits, but it's probably not going to be as much as what you've seen in previous years. Why is that?
See, at this stage in US, we are doing around $1.7 million, right? Growing double digit is a very Herculean task because today we are the highest in terms of the generic market. And I think even if we said we are growing around a high single digit itself is a big thing, which means it has to grow by about 100 to 120, I mean 120 to 150 million dollars. So which is what we are working out by way of new launches, by way of volume increases with the anticipated price stability, etc. We are able to grow by high single digit. That's what we are telling. If the base is very low, probably we may able to grow 10% like that, but our base is significantly high.
Okay.
Now, talking about your EBITDA margin guidance, the top line growth at this point of time appears to be quite conservative from your end. But analysts also point out that as far as the EBITDA margin guidance is concerned, especially after delivering almost 22% plus as far as Q4 is concerned, the guidance that you have given is around 21 to 22% in FY25. At some point of time, especially post H2, will you look at upward revising this particular target band that you've set for yourself? Analysts do expect that Pen-G to start contributing quite significantly.
First of all, the 21-22% is the year as a whole. The business is also undergo certain cyclical. This one, especially on the antibiotic side, it can increase the volumes or decrease the volumes depending upon the seasonality. When the volumes increase, obviously the EBITDA margin comes down, right? So what we are talking about is 21-22%, and don't compare with what is the Q4 number. That is not correct. In terms of the Pen-G, we have said very clearly we are not factored in the improvement in margin on account of the Pen-G, which we said we will do it by the end of the second quarter when the earnings come. That means in November we will be able to tell very clearly.
Okay, so by November, you will probably get a more indicative idea in terms of the margins. But as of now, the margins for FY21, FY25 stand at around 21 odd % in terms of guidance.
Against 20.1 of the last year.
Okay. FY25, Mr. Santhanam, what are you factoring in rather from Eugia Unit 3?
Eugia Unit 3, it has been once again, we made it amply articulated clearly that we will be doing on an average of $150 million per quarter, which means we are talking about $600 million sales in Eugia for the year as a whole. And this needs to be compared with the $540 million on a pro forma basis achieved during the year. So that means there is already an increase of around 10% factored in already. So we are aiming around $600 million for the year.